Welcome to this in-depth session on one of the most important pillars of global financial markets, bonds. When you hear the word bond, it might sound complicated, but bonds are actually a very straightforward concept once you break them down. In fact, they are often called the backbone of fixed income investing because they provide stability, income, and structure to portfolios all around the world. Today, we're going to explore bonds in detail. We'll look at what a bond really is, why it's issued, how it works, the different types of bonds, how they're priced, why investors buy them, the risks involved, and finally, why they matter so much in the modern financial system. This isn't going to be a surface-level discussion. Think of it as sitting inside a lecture hall at Harvard or Stanford, where we dive into theory, practice, and real-world examples. By the end of this video, you will not only understand what a bond is, but also appreciate why it's so critical for investors, governments, and businesses. At its core, a bond is simply a loan. But unlike the loan you might take from a bank, bonds are structured in a way that allows investors across the world to lend money to large institutions, governments, or corporations. When you buy a bond, you are essentially becoming the lender. The issuer of the bond, whether that's the U.S. government, a municipality, or a corporation, becomes the borrower. They promise to pay you periodic interest, which is usually called the coupon, and they also promise to repay your principal, the original amount you invested, at the end of the bond's life, known as its maturity. So, think of a bond as a contract. One side raises capital by borrowing, and the other side provides that capital by investing. Bonds make this relationship formal, standardized, and tradable in global markets. Every bond has 4 key elements you must understand. Issuer. This is the entity borrowing money. It could be a government issuing bonds to fund infrastructure, or a corporation raising capital for expansion. Face value, also known as the par value. This is the amount the bondholder will receive back at maturity. In most cases, bonds are issued with a face value of $1,000. Coupon rate. This is the interest rate paid on the bond, usually annually or semi-annually. For example, a 5% coupon rate on a $1,000 bond means the investor receives $50 per year in interest. Maturity date. This is when the issuer must repay the bondholder the face value. Bonds can mature in just a few months or in several decades. Together, these 4 components create the basic structure of every bond. Let's take a practical example. Imagine you buy a U.S. Treasury bond with a face value. There isn't just one type of bond. In fact, the bond market is extremely diverse. Let's walk through the main categories. Government bonds. Issued by national governments. U.S. Treasuries are the most famous and are considered among the safest investments in the world. Corporate bonds. Issued by companies to raise capital. They usually pay higher interest than government bonds, but also carry more risk. Municipal bonds. Issued by states or cities to fund projects like schools, highways, or hospitals. In some countries, municipal bonds offer tax advantages. Zero-coupon bonds. These don't pay periodic interest. Instead, they're sold at a discount, and you receive the full face value at maturity. Convertible bonds. These start as bonds but give investors the option to convert them into shares of stock, combining features of debt and equity. By understanding the type of bond you're investing in, you can better match your risk tolerance and financial goals. Now, one of the most important concepts in fixed income is how bonds are priced. The price of a bond is not fixed. It fluctuates daily based on interest rates, credit risk, and time to maturity. The key relationship you must understand is this. Bond prices move inversely to interest rates. When interest rates rise, existing bond prices fall. Why? Because new bonds will be issued at higher rates, making older bonds with lower coupons less attractive. Conversely, when rates fall, existing bonds with higher coupons become more valuable, so their prices rise. This inverse relationship is the foundation of bond investing, and a crucial concept for risk management. Why do investors buy bonds? The reasons are powerful. Income. Bonds provide predictable cash flows through regular coupon payments. Stability. Compared to equities, bonds tend to be much less volatile. Diversification. Bonds often behave differently than stocks, helping balance a portfolio. Lower risk. Especially with government bonds, the risk of default is extremely low. This is why large institutions, pension funds, and even individuals use bonds as the stable foundation of their investment portfolios. It's important to contrast bonds with stocks. When you buy a stock, you're buying ownership in a company. Your returns depend on the company's performance and may come from dividends or stock price appreciation. When you buy a bond, you're not an owner, you're a lender. The company owes you money. You don't participate in the company's growth, but you have a contractual right to interest payments and repayment of your principal. In times of growth, stocks may outperform, but in times of uncertainty, bonds provide the steady hand that keeps portfolios balanced. Bonds are often seen as safe, but they are not risk-free. Here are 3 major risks. Interest rate risk. If rates rise, the value of your existing bond falls. Credit risk. If the issuer defaults, you may not receive your interest or principal. Corporate bonds carry more of this risk than government bonds. Inflation risk. If inflation rises, the real value of your fixed coupon payments declines. Understanding these risks is essential because they shape how investors build and manage fixed income portfolios.